All right. If you're serious about investing, you need to know about public.com. That's where you can invest in everything: stocks, options, bonds, crypto. They even offer some of the highest yields in the industry, like the bond account's 6% or higher yield remains locked in even if the Fed cuts rates. What sets Public apart is how they give you the tools you need to make informed investment decisions. Their built-in AI tool called Alpha doesn't just tell you if an asset is moving, it tells you why the asset is moving, so you can actually understand what's driving your portfolio's performance. Public is a FINRA-registered, SIPC-insured US-based company with a customer support team that actually cares. Bottom line, your investments deserve a platform that takes them as seriously as you do. Fund your account in 5 minutes or less at public.com/investing unscripted and get up to $10,000 when you transfer your old portfolio. That's public.com/investing unscripted. Paid for by Public Investing. Full disclosures and podcast description. Hey, everybody. Welcome back to Investing Unscripted, where we ask and indeed answer the hard questions about investing. I'm Jason Hall, joined by my good friend, Jeff Santoro, the voice of the people. Hey, pal, you ready to answer some questions?
I am ready to answer some questions. It is our mailbag episode. So yes, I'm ready.
Before we get going, I just want to compliment our listeners, because our motto for this year has been 2025, when our listeners step up. And you stepped up, people. We've got a lot of questions.
Yeah, we had a whole list of questions in our planner, and then like today, in the hour and a half before we hit record, we got like 6 more. So good job, listeners.
So we're gonna do our best to answer all of them. Some of them might roll over to next month's mailbag, but thank you for stepping up. And finally, people.
Wait, no, hold on. I think I'm gonna issue a challenge here, Jason. I think we can get through all of them. You just have to give shorter answers.
Yeah, we're not going to get through all of them. But thanks for stepping up finally, people. Appreciate it. Now, if we have the best listeners in podcastdom, that we definitely do.
Well, hold on. Look, they've done well with one task. However,
okay. All right.
However, if we're being honest.
Okay, that's fine. You had 2 jobs, people.
The 5-star reviews / 5-star ratings / reviews have been slow, let's just say.
Yeah. I mean, the good things, we haven't had an acceleration of like 3-star reviews. So
that's true. Yes, okay. If we're going to be positive. But
for those of you that keep listening and think we're mediocre, thank you for not expressing that you think we're mediocre.
Yeah, if you're feeling a review that's less than 5 stars, you can just keep that to yourself.
Yeah.
You can send that to us via email. We will take the feedback. No need to leave stars.
You shout at your iPhone, whatever you need to do.
Yeah.
It doesn't involve, actually. No, seriously, put in whatever you think. We need the feedback. More reviews, the better. Helps people find us. The more people that rate podcasts and give reviews, the more favorably the apps look at them and are more likely to put them in front of you might be interested in. And so that kind of thing really, really does help us. So please keep up that. We really appreciate it.
Yeah. All right. Last thing I'll say before we start reading questions here. It was a fun mix this month of our loyal listeners who always send questions in, but we got some new ones in the mix. We're hearing from more people, which means that the ratings and the reviews are helping because more people are finding the show and reaching out and joining our fun little community here. So let's dive in. Jason, our first question came to us via Twitter from Gorsk4023, who had a little bit of a preamble, basically saying he's in a similar situation portfolio-wise to me with a big foundation of index funds and things like that. But here's the question that we're going to dive into. I've been watching valuations in the S&P 500 skyrocket and concentrate among a few huge winners, and I'm aware of the echoes of 1999. Sentiment seems to match the numbers based off what I see on Twitter. Looking at the landscape, listening to smart people, plus Jason, and doing a bit of research, it really feels like a time to rebalance and diversify out of heavy Mag 7 exposure. At the same time, I know that free cash flow yields for those companies are higher than at any point in history, so I'm not out completely. On balance, it feels like something has to give, so I'm rebalancing into majority value funds, smaller mid-cap, and international exposure, all of which are significantly cheaper on a price-to-earnings basis than the big growth / Mag 7 companies, with a much smaller S&P 500 exposure. I'm also holding some cash in money market funds, earning 5%. I feel like this is smart, but it also feels like I'm trying to time the market. Am I being dumb by trying to be too smart? Which is a beautiful way to end that. So I love this question, Jason, because I feel like anyone who owns any portion of the Mag 7 who really thinks about the composition of their portfolio has probably had this exact question. So this will be a fun one to dive into.
Yeah. So as a starting point, I want to make it clear that it was Gorsk who wrote, a lot of smart people plus Jason.
That's a good clarification because
Jeff
that is
did not
something I
ad-lib
would have
that.
ad-libbed, but no, he wrote that.
Yes. So well done, Gorsk. That means you were a loyal listener.
I should also say, Jason, that when we get to a point where the number of questions submitted exceeds our ability to answer in one pod, a sure way to get your question on air is to insult one or both of us.
Yes. Yeah. Agreed. No doubt about it. Absolutely 100% agreed. So I'm going to say, as a starting point, there are probably a lot of people that heard this question and felt seen.
Mm-hmm.
You're not alone. I would say be careful, anybody, about Twitter's sentiment when it comes to investing, because Twitter's sentiment in late 2021 was, hold on with those diamond hands, people. We're going to the moon together. There was not a big sentiment of, hey guys, let's be a little mindful of valuations and position sizing here. And I also want to remind investors too that broadly in the post-financial crisis decade, heading into the financial crisis, the market basically climbed a wall of worry. There were constant concerns about valuations. You have to remember, valuations broadly for a lot of that, especially for large caps, software companies, the big tech giants, were above long-term market multiples, right? So that's important. And the market broadly, the S&P 500 as is in its entirety, it's using dividend yield as a proxy for valuation, was below average. But interest rates were very low, money was cheap. That made stocks kind of the only game in town if you really wanted to achieve anything that was substantially outperforming inflation over the long term and like create wealth. So while all of that was happening, these Mag 7, really it's the 10 largest companies, let's just say that, the 10 largest companies concentrated a tremendous amount of growth. And you talked about free cash flow yields. They trade for higher multiples because they've earned it, because they've been extremely, extremely profitable broadly. Not all of them. Tesla, for example, still has a massive amount of its valuation tied to future prospects, generate a lot of cash, but cyclical. Its automotive business is in a cyclical downturn, right? It's peaked last year and we're actually going through a little bit of a decline right now. But broadly, again, Microsoft and Nvidia, et cetera, yeah, their free cash flow yields are just incredible, right? So I do think shades of 1999, maybe a bit of a stretch, because in 1999, there was a lot more high hopes baked into a lot of companies broadly, right? Broadly.
Yeah, it seems like that high hope right now is more concentrated in parts of the market.
Yeah. But it's also based in something that's real.
Mm-hmm.
And could help these companies meet those expectations for their next leg of growth with artificial intelligence. I don't think there's any doubt in a decade or 20 years, certainly, we will look back at this period of time and say, holy crap, all of that artificial intelligence stuff, it happened. In the same way that if back in the late 90s, early 2000s, we look back now, everything's on the internet, right? Everything.
Yep.
So it all happened, right? It's just that the timeline and the expectations, I think the expectations and the timelines are directionally probably closer to reality now than they were back then. But that doesn't mean that top 10 stocks that represent, I don't know, 40% or more of the S&P 500's market cap isn't set up to cause a lot of investors pain.
Yeah, I think what's hard about this is I'm pretty sure if you go back and listen to any conversation we've had about the Mag 7 since we started this podcast during the bear market of 2022, someone, whether it was you or I or a guest, said something like, well, this at some point, this Mag 7 has to slow down. And the problem is to the point that Gorsk makes at the end here, am I being done by trying to be too smart and timing the market? No one knows when that'll be or if it'll be. You know, I think you could have made the case in 2021 that, all right, something's got to give with these companies. And here we are, 4 years later, and they're all still doing really well.
Yeah.
But part of the question I wanted to hone in on here, Jason, is he asks about this being a time to rebalance away from the Mag 7. And I don't know what that means to Gorsk, right? Does that mean selling some of those to buy other things? Or does that mean just diversifying away by putting new money into other things, right? There's a couple ways to accomplish that where you're not limiting your exposure to those companies necessarily, but maybe limiting their exposure to your portfolio. And I think that's where, not that we're going to give Gorsk advice here, but I wouldn't know what to advise even if I was going to, just because I don't know that part.
Yeah.
But that's kind of how I would think about it. I have other thoughts about this in light of some other context he gave that we didn't read, but I want to see what you think.
Yeah. So one of the things that we do know about, and again, Gorsk, you know this, I'm going to say it anyway. We're We're not advising you if what you're doing is the right thing to do and you should change it or not. We're just generalizing here for our broader audience. But one of the things we do know is that, again, like your situation, this is all through like company retirement plans. So no individual stocks, it's all mutual funds and that sort of thing. And you don't have like all of the hundreds of different targeted ETFs that you can use to invest in much more targeted or specific things. So we know Gorsk has done things like moving more money into like value funds and less of like the broad market index funds and some international exposure and things like that to try to reduce exposure to the largest, that concentration through the S&P 500. So I think that, I like the idea if it's the sort of thing that can help reduce downside exposure for investors who are at a point in their investing career where reducing downside exposure should be a priority. We don't know the Gorsk is 30 and still has 35 years of compounding and net contributing, or if Gorsk is planning to retire in the next 5 years, right? So depending on where you are in your investing career can vastly affect what would be the right thing to do. Like you said, you go back a few years ago when we were having a similar conversation, when we were talking about, just getting one company into the 7 comma club. And now we've got 3 that are worth 3 trillion and a couple more that are also in that, 1+ trillion market cap company. I think there's a total of 5, I think now. It's incredible. So the point is our minds struggle with big numbers, and it can be hard imagining that these big companies that have become mega companies continuing to get larger and grow their cash flows. It's just hard to wrap our heads around that. But I would say the biggest thing is that if these changes are helping you manage yourself so that you don't do permanent harm to your portfolio and other things like moving substantially to cash when you're still 10 or 20 or 30 years away from retirement and you're still staying exposed to the market, that's the main thing, right? Maybe you don't get the best part of the returns if we do see like all of the highest expectations things happen quickly, like more quickly than they probably will. And these companies earn these big multiples and they keep growing their profits. And we don't see a big pullback of CapEx, or maybe we do see the big pullback of CapEx for growth, but the cash flows are coming in and we see other companies begin spending CapEx and it keeps lifting NVIDIA higher and Taiwan Semi, which is one of the other $1 trillion companies. So we don't really know how it's all going to play out. We can think about the probabilities of how it could play out. And sure, from a probability perspective, there's a good chance that we're going to see some turnover at the top because we look at over a multi-decade period, every 10 years, we do see a big turnover of the top 10 companies. Like it just happens consistently, and very few manage to maintain the holding in the top because disruption happens and industries change and innovation happens. And so all of those things are kind of going to come into play. But looking beyond the probability of what the companies are going to do, you have to think about your own probabilities as an advancer, as an investor. And what are you trying to accomplish? Like, again, if you're still 10, 20 years plus from a financial goal, putting a kid through college, retiring, or whatever, the probabilities are just staying invested in equities and having exposure to the companies that have delivered the best returns is probably going to deliver the best results. And if it doesn't, what's going to happen, those downturns that you go through and you're contributing more money every pay period, you're going to buy when things are cheap too, not just when they're expensive. And it's going to work out pretty well. But if you've done really well over an extended period of time and you're getting closer to your financial goals, maybe missing out on some of the upside because protecting downside is more important, but still getting good returns is what you need to do.
Yeah. And the other thing I'll say, and we can move on to the next question here, is he mentions having a bunch of index funds, but also a small brokerage account. So I would say one thing I did, and I talked about this on the podcast, but I don't know if everyone heard it, and it might be worth considering, is I ended up selling some of the Mag 7, not even just the Mag 7, but just stocks that appear frequently in things like index funds and ETFs that I also had individual stock holdings of. I actually ended up selling out of them mostly to whittle down my stock portfolio into something that was a little bit more manageable for me because I like to track everything really carefully. But because when I added it all up, I had a lot more exposure to a company like Apple, for example, than the handful of shares I had in my brokerage account when I really looked at it. My index funds and my retirement accounts and mutual funds and my wife's and things like that. So that's another place for people who do have exposure to funds in their portfolio to do the math and figure out, I own Apple and I also have a lot of index funds. How much Apple do I really own? Because that could be that could be eye-opening. All right, next question comes from Jordan, also via email. Thank you for all your hard work and entertaining investment podcasts. I have been a retail investor since late 2018 and have averaged above market returns. I try to soak in as much investing knowledge as I can from multiple sources. I have recently started purchasing preferred shares of 2 different equities lately, and I'm curious if this is something either of you have ever invested in. I have about 5% of my portfolio in this type of investment, and it just seems like in this environment with Fed rates going down, it would be a worthwhile investment. With a call date of late 2026 and current prices in the upper teens with yields from 7 to 8.5%, I would think this type of investment would be worth it. Is this something either of you have ever looked at? Maybe worth a segment in an upcoming podcast. As listening to different shows, no one seems to give any time to this type of investment. So maybe explain what that is a little bit, Jason, because that's new to me, and then share some thoughts on it.
Yeah. So preferred stock is really closer to bonds than stock. And the reason it's called preferred is because where it stands in the capital stack, it's ahead of other types of investments or debt in the order to be repaid. So preferred shares, for example, if a company pays a dividend, if the company cuts its dividend, the preferred shares still get paid. It's built into the preferred share what the dividend is going to be. So whereas a common stock, the dividend is just an implied promise. It's not guaranteed. Also, preferred shares, if in a worst case scenario, there's other kinds of debt, actual true debt, company bonds, convertible debt, other kinds of notes that stand in front of preferred shares, but preferred shares stand in front of common shareholders to get repaid in a bankruptcy or a bad situation like that. They tend to pay higher yields than this company's stock. They'll often pay higher yields than the company's debt will as well. But just like bonds versus stock, the upside with stock is the company becoming more profitable per share and that driving the value of the stock up. You don't really have very much upside, if any, with most companies with the preferred shares with the share price. You don't see a lot of volatility like you do with common stock prices. He mentioned the call date of late 2026 with some preferreds he was talking about here. A lot of preferreds are perpetual. Some do have call dates where the company can pay you basically to retire them, to buy them back for the strike price, but a lot are perpetual. I do think for investors that are willing to take on a little more risk than bonds in businesses that they understand and know well, preferreds can be a good way to get high yield. But again, if your goal is really largely to accumulate wealth in the market that we've seen over the past 15 years, preferreds would are going to lag the market's portfolio. But if you're looking at protecting against downside, preferreds can be really attractive.
Yeah, I was wondering as you were explaining it at the beginning what the downside was, because it sounded really great until you got to the part where your upside's limited. So I think that's the piece to think about it. This is a strategy anyone's considering.
It's not really stock. It's a form of debt as far as the way the market treats them. So it's like a bond.
Yeah, and we're not going to talk about it now, but personally, I think that is a fascinating aspect of how corporate structure and debt and stock works. Like just the pecking order of who gets paid in what order if something goes south with a business.
Mm-hmm.
And it plays itself out anytime there's a bankruptcy. If you ever read about bankruptcies, it's all about who gets pennies on the dollar, who gets made whole, who gets nothing. Common stockholders are the absolute bottom of the totem pole, is my understanding. That's the absolute last
in line, and you've got your suppliers and vendors are first, employees pay first, and then you start working on other vendors, and then you get into lenders, and then like I said, at the very bottom of that ladder is going to be the common shareholders. It's a business. You pay everybody that you owe money first, and you're the owner of the business. If there's anything left after you've paid everybody that you owe money to first, that's what you get.
Right. And I used to not understand why that was. And then that's the way you have to think about it. Like if I owned my own business and it went out of business, I'd pay back all my debts. And if I got nothing at the end, well, that's on me.
That's exactly right.
And that's on us as common shareholders. We are tiny, tiny minority owners of all these businesses.
That's right. Right. I mean, you might make a case against the management because frankly, we have far less influence on management than probably we should.
Hey everybody, we'll be right back, but first a word from our sponsors.
FinChat.io is the complete stock research platform for fundamental investors. They have all the standard financial data on more than 100,000 stocks globally. But beyond that, they have company-specific segment and KPI data on around 1,800 stocks. So for example, do you want to see NVIDIA's data center revenue growth? They've got it. Do you like to track Apple's iPhone sales? They've got that too. Or how about nights and experiences booked for Airbnb? You guessed it, they've got it. And they just added around 8,000 ETFs and mutual funds to the platform. The breadth of FinChat's data is truly one of a kind. I use FinChat every single day as I'm researching the stocks in my portfolio, specifically when I want to see how they're doing on KPIs that FinChat is famous for. So to get 15% off any paid plan, go to finchat.io/unscripted. That's finchat.io/unscripted to get 15% off any paid plan today. The link will be in the show notes. Hey, Investing Unscripted listeners, this episode is brought to you by our friends at Yellow Brick Investing. Yellow Brick is an aggregator of the best stock pitches across the internet. By tracking thousands of blogs, newsletters, fund letters, podcasts, and more, they're able to collect and summarize the best stock pitches from all over and bring them to you in one single place. Think of it like a modern value investors club. I have to say, this is pretty cool. I can just type in the company I'm interested in and get a bunch of different stock pitches from across the internet. It helps me think through new ideas and find opposing points of view on the stocks I'm interested in. And the best part is, access to Yellowbrick is completely free. Try it for yourself. Simply go to joinyellowbrick.com and search a company or ticker you're interested in. You're bound to find a great report on just about any company. That's joinyellowbrick.com.
But
Yeah.
it is what it is.
All right, this next email is less of a question and more of a sharing of a story. But I think it's, I don't know, it made me feel good. So we're going to read it on the air here.
In this edition of Stroking Jeff and Jason's Ego.
This came from Andrew via email, who wrote, by the way, I apologized to Andrew on email because this actually came in the beginning of November and I just missed it. So a belated email read here. 'Tis the season, and my email is mainly to say thank you. My partner and I had built up some substantial credit card debt over the last couple years due to a career transition and some unanticipated life expenses. Yesterday, I decided it was time to sell some stock in my taxable account, take some gains off the table, and pay down most of that debt. It felt damn good. This was a great reason to sell. Grateful that I started this financial journey more than 5 years ago that has led me to become a Motley Fool Stock Advisor member, a listener of this pod, and a general devourer of stock content. Hope you guys have a great holiday with your families, enjoying great food, drink, and football. I did all those things, so thank you belatedly.
This made my Christmas a little better.
Yeah, this was really nice to read.
I just heard it for the first time right now.
I want to say two things about this. One, as two people who talk into a computer screen at each other, it's nice whenever we find out someone listens. Like, I truly mean this anytime we get an email from any listener. I'm just astounded that someone listened and took the time to write us. And we could pat ourselves on the back for any role we played in Andrew making a decision that he felt great about. But the thing I actually wanted to talk about is this whole idea of why you invest and when you should sell and when you should, quote unquote, take gains off the table. And we spend a lot of time talking about setting long-term financial goals and saving for retirement or maybe a kid's college, and all that's super important. But sometimes you look at your debt and you look at the amount you could get for selling some stock, and the decision for that person is, I'm going to just settle this now and clear this up. And I would argue sometimes that may not even be the best financial decision. I'm not saying this for Andrew, but like if you asked 100 professionals, 98% or 58% or whatever might say, maybe not, maybe do it this way. But sometimes just clearing that off of your shoulders, can be exactly the right move. So that's the piece of this that I wanted to talk through, not so much the thanking of us that Andrew did via email.
I'm gonna invert this and Charlie Munger this a little bit and talk about the brutal, painful, wealth destroying power of credit card debt. And my hope, Andrew, is that you've been fortunate enough to have a few small investments that have done extraordinary over the past few years that were one of the catalysts for you saying, well, I need to take this incredibly lucky timing to have bought these great investments that have appreciated so much to get this stranglehold off of my financial throat, right? Because it's not often that we go through periods like the past 2 years where the market broadly has probably generated returns that are actually higher than the credit card debt most people would have paid over that same period, right? Most credit cards, if you've got a good credit score, you're still paying more than 20% in interest rate. Right. We just happen to have, over the past 2 years, gotten about 60% in total returns combined that have made it a better investment than paying off that credit card debt prior. Here's to a wonderful decision. May you pay off your balances in full each month henceforth. And may all of our listeners do the same thing.
Yeah. And I agree with all that. It's all of the personal finance stuff that we sometimes touch upon, having enough of an emergency fund and all that kind of stuff. Stuff does come up. I will admit that you know, if there's a legit emergency that's beyond even what you planned for and credit card debt is the way to get through it in the short term, I get it. That happens to people. But I think the goal is to the best of everyone's ability, plan so that is not the case. It just goes to show that, you know, I guess my point is like, we talk a lot about the long term and sometimes it's a short term thing that the investing can help you get through. So I thought that was
I don't care how fast of a swimmer you are, you can't outswim a current like credit card debt very often.
Yeah, it's tough.
Right job, Andrew.
Yes, agreed. From Colin via email, looking for some help on valuing REIT distribution payout ratios. Is it best to use a FFO payout ratio or an AFFO payout ratio? What's the biggest differences to know and which is the best one to use? Also, while we're at it, each pick a desert island REIT that you have to own for the next 5 years. Now talk at us with your answer. After all, that's what we're all here for. So we'll come back to the desert island REITs in a second. Jason, before you answer this, because you know more about this than I do, I'm going to share what I know about these acronyms, and then you can correct me. So when you're looking at REITs, which are real estate investment trusts, and by the way, that is an asset class that trades like a stock. It is a stock, but to be a REIT, you have to pay 90% of your taxable income out as dividends. So a lot of people looking for dividend income will look at the REIT sector for a way to get that in their portfolio. Because GAAP accounting makes things like depreciation for REITs, so much of their business is land or a building, right? So funds from operations, FFO, that's basically just a proxy for profitability is the easy one sentence way to think about it. So that's just a little context on REITs and these acronyms, because I know sometimes we over acronym at people, but when you're looking at distribution payout ratios, Jason, is it best to use FFO or AFFO?
I want to give a little more context. The 90% of your net income as dividends is one of the qualifiers. There are some others, like a percentage of your business that's actually in real estate. And there's different things that can qualify that. So like there are companies that buy mortgages and other debt, mortgage REITs that hold that debt that are technically REITs, but they're really financial instruments and they're very different, very difficult.
Different than what we're talking about with REITs here.
So equity REITs is generally when people say REITs, so companies that own property and lease that property to somebody, or they own the property as investment and they operate it in some way. That's what we're talking about. So I want to encourage anybody, if you want to know more about REITs and these definitions, go to the National Association of REITs website. That's the trade group for REITs. It's just REIT.com, REIT.com, because all of these terms and industry terminology are agreed upon by the industry and they're standardized because FFO is not a GAAP.
Right. Standardized, but it's not GAAP accounting.
Right. Earnings per share is GAAP. FFO is not GAAP, but it is the most important metric for understanding profitability, like you said, for REITs, specifically earnings per share. It is the proxy for earnings per share. What it does is it takes earnings per share and then it adds back in all of the expenses that a company takes related to their core real estate business. So you buy real estate, you spend $1 million, and then you're going to depreciate that $1 million based on GAAP, how long you depreciate it. Real estate generally appreciates in value. So, and it's the core business. It's not like a factory where you're going to dump a bunch of capital in buying new equipment, so the depreciation is of an asset that's probably going to hold or generally over the long term increase its value. So you add that expense back in. That's the big one. You add that back in, and that's what FFO is. Now, the exceptions to that, if you take a loss on a real estate asset that you sell, you don't get to add that back in. It's your core recurring business. You don't get these one-offs and stuff that you don't get to fudge the numbers with. AFFO is an agreed upon term. It's funds from operations that's been adjusted, just like adjusted EPS. But just like adjusted EPS or adjusted free cash flow or adjusted whatever, there's no standard for what those adjustments are.
I was just going to say that. And I even own a company that gives FFO, gives AFFO, and then gives FFOAA, which is funds from operations as adjusted, or maybe it's even adjusted funds from operations as adjusted. I mean, it's just like ridiculous. So you really have to read in the SEC filings what they're adjusting. So it's not always.
Some companies also report like normalized FFO, which is takes their FFO of the go forward business. For example, if they've done some asset sales and it normalizes, or if they've made some acquisitions and it normalizes their FFO based on like the core businesses that exist going forward. So, but you have to understand what are the adjustments. So for example, let's say a company owns strip malls. That's a terrible example. Let's say they own hotels And they're operating the hotels too. They're not just the owner. They're not leasing it to an operator. So they have some expenses related to real estate that are recurring, that are always going to be recurring, like painting, updating fixtures, replacing the carpeting. Their AFFO, they may back all that stuff out. And that's what I call bullshit AFFO because
Yeah, you have to really,
it's a real like thing. But
So
there are other companies that their AFFO, they're adjusting out like one-time gains that under FFO they might be able to normally get away with. You need to understand what they're adjusting.
Would you say it's fair then when you're comparing one REIT to another, it's fair to compare FFO, but you really can't compare AFFO or unless you really know what they're adjusting for, just like you can compare earnings per share in a non-REIT stock, but you really can't compare adjusted EBITDA or something like that. Hey, everybody, we'll be right back. But first, a word from our sponsors.
All right. If you're serious about investing, you need to know about public.com. That's where you can invest in everything: stocks, options, bonds, crypto. You can even earn some of the highest yields in the industry, like the 6% or higher yield you can lock in with a bond account. Public is a FINRA registered SIPC insured platform that takes your investments as seriously as you do. Fund your account in 5 minutes or less at public.com/investing unscripted. Get up to $10,000 when you transfer your old portfolio. That's public.com/investing unscripted. Paid for by Public Investing. Full disclosures in podcast description.
Hey, Investing Unscripted listeners. My name is Brett, one of the hosts of the Chit Chat Stocks podcast. If you love Investing Unscripted, we think you will love listening to Chit Chat Stocks. On our show, we research individual stocks, interview investing experts, and, well, chit chat about investing every single week. From hot stocks such as NVIDIA and Celsius to hidden small cap gems, we have something for every type of investor. Follow the Chit Chat Stocks podcast on YouTube, Spotify, or Apple Podcasts and start discovering new investments today.
Right. Well, adjustments are like opinions, and opinions are like something else that begins with an A.
Yeah.
Everybody has one. So,
all right.
Yeah.
Well, we're deep in the REIT weeds here. So let's pull ourselves out and let's answer Colin's question about which one do you look at for payout ratios, and then we can each give our
leery with using adjusted numbers for things like payout ratios or valuations, just like with forward earnings guidance. Forward earnings guidance are adjusted analyst estimates, right? So they're always going to look better than reality. So you have to be careful with that. And depends on the company. Like Realty Income, the adjusted metrics they provide are actually pretty good. They're useful. So it can help. So the key with the payout ratio is it's the percentage of the company's FFO that supports the dividend. So just like a regular earnings payout ratio or a cash payout ratio, less than 100% means there's something left over after you've paid the dividend. More than 100% means you're depleting your balance sheet to support a dividend. So I think as a starting point, you have to look at it over a multi-year period. You can't just look at last quarter or last year, but I would just go with the FFO payout ratio for most REITs, with a bare few exceptions. And as a general rule, like I wouldn't want the payout ratio to be more than like 70 or 80%. I mean, they're required to pay at least 90% of earnings per share. Their FFO should be a lot higher than earnings per share.
All right. Do you have a desert island REIT? Have to own it for the next 5 years?
This is a boring, very unsatisfying answer, but off the cuff, if I was going to buy a REIT today, had to hold it for 5 years, had to go live on a desert island and couldn't make any changes, it would probably be Realty Income, because I would feel very confident I could come back in 5 years and not have to have any worries. Maybe Prologis too. And I don't even own any Prologis, but the stock has come down a ton. It's the biggest REIT. They're well capitalized. Their cost of capital is leading. I'd say either of those I'd be happy with. Sorry, I'm not giving you some little unheard of, sneaky little secret winner. The two of the biggest that are the best in the business.
Yeah. It's funny. When you first said desert island, I was thinking longer term than 5 years, which just goes to tell you how long I think.
I mean, if I was on a desert island for longer than 5 years, I'm probably going to be dead. So it doesn't matter. Let's YOLO this.
So
Make my heirs rich.
I also don't own a lot of REITs, so it's easy for me to just narrow it down to the couple I do own. I mean, I'm a big fan of Ryman Hospitality Properties. I've talked about it a lot. Ticker is RHP. They own big hotel and conference space mega cities under glass in a bunch of locations around the country. They also own a bunch of entertainment venues in Nashville and some other places. And I just think they're well positioned for the next 5 years to continue to do what they're doing, just rent out their hotels to big conferences and charge a lot of food to the people there who are at the conference. And
if you want to do a corporate event or an industry trade event and you don't want to do it in Vegas, good chance that you're going to do it at one of the Gaylord properties they own.
Yeah. I've been to conferences at the Gaylord properties, and I can tell you they are these amazing little cities under bubbles. And it is, you're buying $22 hamburgers for lunch. So, it's a brilliant business. So anyway, all right, we won't go any deeper into that one. All right, next couple, I think we can just do quickies on these. These are YouTube comments, but they are about specific stocks that we know. So I think it'd be fun to answer them. So this one comes from Yazanasad 7811 on YouTube. I'm sure I'm butchering that. It says, thanks. Valuation for Mercado. Would you buy today? Margin of safety. And I'm assuming they're referring to Mercado Libre.
Yep.
I'll answer first, and then I want to hear your thoughts. I would absolutely buy this stock today. I don't think it has seen the multiple expansion that most of the market has seen. And every time I go back and look at what they do each quarter, it's 20% growth here, 30% growth there, 40% growth there. I mean, it's just super impressive every quarter. Margin of safeties, I'll let you talk about that because I know you have some loan risk concerns about them, but I'm a huge fan and I actually don't think it is a overvalued stock right now.
So for a little period of time, one of my home builder stocks had passed it, become my largest investment, but I'm pretty sure Mercado Libre is back in front. Home builder stocks have sold off a little bit. And this is definitely one of my top 2 or 3 in terms of cost basis of dollars that I've spent to buy shares over the past 12 or 13 years. Love the business. It's exceptional business, well run, know the markets they operate in, which is very challenging. Latin America is very dynamic, loaded with risk, as we've seen with Brazil. Love the growth opportunity in Mexico. I think investors might be sleeping on some of the potential for that whole economy. And Mercado Libre is starting to make some interesting moves there. Love their payments business. It's a real differentiator and a massive, massive moat. They've gotten big enough, and I think all of their markets, for the most part, that they can self-fund. They don't have to rely on capital markets or debt markets to raise capital to continue expanding. That's a huge advantage over most of its potential competitors. But I do have some worries about how much finance has become a bigger part of their business, lending to merchants, lending to consumers. And look at what's happening in Brazil. Brazil's currency's been devalued a ton. There is a lot of risk there to their e-commerce business in the near term. I don't think it's like permanent harm level of risk, but when you go through massive inflation, discretionary spending gets squeezed. That's not great if you're, any sort of retail, reseller, commerce business. And I'm pretty sure Mercado Libre's biggest debt book is Brazil. So another thing that could get squeezed, if we see some serious economic weakness there, we might start seeing late payments and defaults on some of its debt from some of its borrowers. That worries me a little bit.
And I'm guessing that's a lot of why the stock has not run up like some others have.
Yeah, no, that's why it's down like 18% over the past, 2 months, 3 months, maybe. The Brazil thing's that's big thing. Historically, if we've seen the stock fall 18%, it has always turned out to be a good opportunity to buy. Again, I have a lot of exposure to it. It's one of my biggest investments, both on the dollars I put into it and the percentage of my net worth that it represents. I'm not running out to buy more shares because I have a pretty large exposure. I could definitely understand investors with a long time horizon, not a couple years, but 5-10 year plus period that don't have a lot of exposure, looking at this as an opportunity to start a position, maybe add a little bit to it. It's been a volatile stock over its history too. So the market has always given us opportunities to buy at good values down the road.
Yeah. One of the things I like to keep an eye on with that company, and I think they report this, but it's pretty easy to track, is just how much of their business comes from specific companies in Latin America. And I would love to see the Mexico portion of that pie increase over time, because I feel like of the companies that they're in, that's the most stable and also probably has the biggest growth opportunity moving forward over the next couple decades. So I actually am interested to see if, I don't know, what management can do to sort of tilt the scales a little bit away from Brazil if they also see risk there. But it'll be interesting that's just something I keep an eye on. I agree with all those risks. I could be totally wrong about this. This is not investing advice. I just feel like the business is so strong and well run and serving an important need in a part of the world that needs it'll get through those rough patches, but yeah, I think they could be rough patches.
Well, position sizing, multiple buys over many years and a long time horizon. I think that's how you minimize that risk and maximize the opportunity.
Yeah, because in the absence of that risk, if you just look at the results, it should be trading for 60 times earnings. It executes incredibly well.
Yeah, I got to look that up now before we move on. 14.5 times free cash flow, 13 times operating cash flow, price to earnings of 62 times.
Oh, it is that high for price to earnings. Well, the cash flow is pretty good though.
Talk about SolarEdge real quick.
Yeah, we had another comment on YouTube from Mr. Go and Rush. Any update on your thoughts on SolarEdge? It went down even worse since you made this video. It was a video comment, one I think you did with Tyler on our YouTube page. Do you think it is the bottom now, and is and time to come back, or could be even lower?
So SolarEdge and Enphase are the two leaders in the electronics that take the DC current, turn it into AC, and manage the panels at an individual level. Enphase has navigated this downturn extremely well. They keep generating free cash flow. They pivoted their manufacturing to the US. Some of it that was in Europe, they shut down that contract manufacturer and consolidated to the US so they can leverage some of the tax incentives. And we know there's a big push for domestic jobs. So I think it's put them in a really good position. SolarEdge has been a lot slower to do that. They've started more recently. They just announced a big deal with Summit Ridge to really start pushing harder. They've been steadily increasing the percentage of the components in their battery that are domestic content, increasing their ability to take advantage of some of the tax credits for domestic manufacturing. Again, these are all things that they probably should have been doing sooner, but they're starting to do now. I think they still have a ways to go because Enphase has started to take more market share from them because they moved more quickly to get competitive on cost, which these incentives are helping to do. And that was the whole point, bring more manufacturing back to the US. That's where the incentives are designed to do, but also that's driving out cost and helping Enphase compete on price. SolarEdge has still got some work to do there. I need to see a little more before I'm ready to commit any capital dollars to them. So it's getting better though.
Yeah, I've not looked deeply into SolarEdge. There was a while when I was very excited about Enphase and I never bought it. And I'm glad, because if you looked at the stock chart from the day I thought I'd liked it to now, I made the right decision. I think what's holding me back is the second part of the question here, which is this the bottom? And I just,
So
maybe I'll
say.
feel, in 6 months, I might have a little more clarity if we get some, actual policies and not just talk or lack of policies out of the new administration. But I just feel like if we hear like a month from now, the government's like, no more solar subsidies, like the stock's going to go down. So
Yeah.
it's a little bit in my too hard pile for me right now.
Well, I think this is a perfect example of one that instead of trying to get perfect and precise and catch the bottom, I'd rather buy the stock in 6 months, even if it's up 25-50% or doubled from here when there's clear signs in the
But you have
business
clarity.
results.
Yeah.
Right. Yeah, exactly. Because catching the bottom on a trade and then the stock runs up and then turns out their business is still a mess, and I would rather, like I said, wait for that clarity. And then because as a long term, the stock could double from here. And if they get everything together, it would still be a really attractive price based on the potential for the business to recover.
Yeah, that makes sense. All right, next question came from Damien via email. Thanks for the podcast, and it is immensely enjoyable and informative. I was wondering what metrics/information you use when comparing similar companies, C3AI versus Snowflake or Allegiant versus Danaher. I think working out the company's key info is more important, but I am thinking that comparing with like companies is a key part of that. Would you agree, or is that just creating work for ourselves? Thanks for the show from down under. Love the banter. All right, we got an Australian listener here.
Cheers, mate.
So I thought this question was interesting. I thought about it. It's funny. I track both the usual metrics that we compare all companies. Like I track revenue and revenue growth and margins and profitability and cash flow. And I also track each company that I own's key performance indicators, which are the metrics specific to that company, the ones that they report out, that they identify in their filings as being the important drivers for their business. I find that I don't compare businesses to other businesses that often, just generally, even if they are direct competitors. But I think where I do, Jason, and I want to know if you do this differently, I look at not so much nominal numbers, but growth rates and margins. So I'm less interested in company A bringing in $8 billion in revenue versus company B who brings in $200 million of revenue, as I am if company A is growing revenue at 20% and company B is growing revenue at 3%. Like I look at growth and then also just margins, like gross margin, operating margin, net income margin. Like I like comparing the GAAP metrics that way and then keeping the company specific metrics. I don't typically compare them with others unless they're like identical things. Like sometimes the way a company calculates dollar-based net retention rate is exactly the same as another company. And then maybe you can compare it, but those will all be different company to company. So that's how I think about it. I'm curious how you look at it.
Well, I think that's kind of Damien's question, though, dealing with companies that are peers and comparing them to one another. I do think that can be a really useful thing. And I'll use Lowe's and Home Depot as an example. If you were an investor most any time over the past 20 years, looking at Lowe's and Home Depot, and you were just going to buy the one that was the best valuation, you would have bought Lowe's every time because it's always been a cheaper stock.
Yeah. But there's a
on
reason.
There's a very big reason. Yeah, on
Yeah.
a price earnings basis, it's almost always cheaper. Price to free cash flow, any of those like core earnings per share driving value creating metrics. Jeff's reason that he alludes to is that Home Depot has been substantially more profitable, turns inventory better, which results in better operating margins, has been able to generally get better gross margin, has been a more efficient business, has grown at a faster rate for most of that period, has just been the better run business and has earned that higher multiple. And historically, I don't have it right in front of me, so I'm probably going to put the lie to myself here because I know Home Depot stock has struggled a little bit recently, and I know Lowe's probably hasn't done necessarily great either. But over the long term, Home Depot has been one of the best stocks you could have ever bought, right? It's been an incredible winner because it's been better at compounding earnings, right, on a per share basis than Lowe's. So I do think it can be useful. But again, the key is like, I'd say C3 versus Snowflake. There's some pretty substantial differences between those businesses in terms of scale and revenue and product, go-to-market strategy, what they're actually selling. But directionally, I agree. Like I'd want to take CrowdStrike, and if I was interested in SentinelOne, and compare some of their core metrics to kind of figure out, is SentinelOne is the more of the upstart here? Is it gaining share? Is it closing the gap between what has definitively been described by people that I know inside the industry and everybody that all the trade stuff that I've read? CrowdStrike is dominant and SentinelOne is just the other also ran pure play, right? But it can give you some idea of, can it also still be a winner? Is it close enough? Is it doing things well enough? Are its margins good? Growth rate's good? Is it making the transition from cash burn to free cash flow at a similar point in its existence to when the larger company, the more mature company did it? Like those things can definitely help inform, like, what's the trajectory here? And does this add to my probability of finding a winner today, or should I avoid it? And it can definitely help you figure out, well, which is the better business, right?
Yeah. Now that you said all that, what it reminded me of is when I have compared companies more closely, it's been trying to figure out if the valuation difference between the two is warranted or not.
Yeah. Yeah.
Because sometimes you will compare two companies that are competitors, and it turns out that the one that's more expensive actually is growing revenue more quickly. And maybe to you, that's an indicator that the market hasn't mispriced or not. But that's one place where sometimes because to me, sometimes the disparity, if a name gets hot, the disparity can be huge. A company could be trading for 30 times earnings, another one could be trading for 12, but the one that's trading for 12 is actually growing revenue faster. And then you have to be like, oh, that's interesting. Like, why is that disparity there? So that's how I've used it the most, but I probably should be comparing competitors' metrics a little bit more than I do. So I'm glad this question got asked because it's got me thinking about my own portfolio.
Damien, you have helped us in our efforts to fix Jeff. Thank you.
Thank you. Thank you, mate. Is that what you say to people from Australia?
Cheers, mate.
All right. Good friend of the show, Sina, sent us about 11 questions relating to the episode about options that we had a few weeks ago with Jeff Fisher. We can't answer all of these, Sina, but Jason, what's one of the questions on here that you think would be one we can highlight for today?
Yeah, here's one. Have you felt like you need a different temperament or perspective for working with options versus other investing? This is kind of an it depends one, because with options, you can do a lot of, I'm going to say it, you have options.
Anyone who turns the podcast off now, I would not blame you, but just wait till the ads run.
If they've been here long enough at this point, Jeff, we'll get paid for the ads, whether they stay or not. All right, so I apologize for that, but I'm not sorry. Do you need a different temperament or perspective for working with options versus other investing? So I think yes, and also no. As a starting point, the things that are really valuable that you can build as a long-term business-focused investor: patience, not letting emotion grab the wheel, sticking to your guns, thinking about valuation, understanding the underlying business. All that stuff still applies and makes you a better investor who is investing options too. Absolutely important. Because when you screw up investing with options, it's almost always because things are not going as planned. You don't necessarily know the underlying businesses that well. You don't understand the valuation, maybe. You bought something because you got a hot tip, not because you knew what the hell you were buying. And emotion comes in, and fear and greed screw up your results. Right. It's just the reality. With all of that said, because so many of the different ways that you can invest with options are short term, from a few days to a few months to, it can go as far as, a couple of years. I've got some options right now, Jeff, that have over 700 days before they expire. So they can go longer. But again, even a couple of years is still pretty short term. But also because options can have very binary outcomes. And sometimes you have to do something. You have to act and make a choice and do something to profit and or to avoid losses. So for example, you might buy a call on a stock and the price you pay for that call is, I'll give an example. I'll build one. We'll make one up. Let's say you buy a $10 option on a stock for June 2025 and you pay $1 premium. So what you've done is you paid $100, $1 per share. The contract is 100 shares. So you paid $100 to give you the option. You control the right. You paid the money. You control the option to buy 100 shares from the person on the other end of that contract for $10 a share in June. The point is between the day that you buy that call and the day that it expires, you need to be prepared to act for that to be profitable. And you also need the stock to get above $11 a share, generally, right? Not always. I mean, there's some things that can happen depending on what was the price of the stock when you bought that $10 call, that kind of thing. But the point is that it's binary. You're either going to make money or lose money. And a lot of times you might be selling it a few days or a few weeks before it expires and just scraping up like 10% or 20% of your investment. On the other side, that you might sell a put, for example, and the difference is somebody's paying you, they hold the option to sell you a stock in the future. It's inverted though, right? They only want to sell you that stock if the price falls below the strike price, because that means that they can sell it for more than the market's bearing for that price, right? You sell a put for a stock at 10, it falls to 5, you have to buy it for 10. Whoever's sold that put when it comes to that point, you're going to pay $10 for $5 stock, right? So you might not have to do anything. If the stock goes to 30, it's that put that you sold is going to expire and all the premium that you got paid, you just keep it. But there's short term, you have to change your mentality around that. You have to be willing to think about acting quickly. If there's an opportunity to make the amount of money that you deemed acceptable, even if it's well before that particular option would expire, maybe a stock goes up a ton on a call that you bought and you can make money 3 months early, take the money, move on, find the next option trade, rinse and repeat.
Yeah, I agree with everything you said. I don't want to belabor the point. I'll just say the way I think about it differently has a lot to do with, I feel like I have to be more patient with options, like even doing weekly ones. Like I have to make sure I'm not going to rush into something where I might get the shares called away at a loss for my overall strategy, or if I don't want to lose the shares, I have to be a little bit more careful. But to me, it's more about, we sometimes answer the questions like the desert island question, like if you had to own a stock I'm a lot more careful about and by the way, all I'm talking about is selling covered calls on every week, right? Just for income. But I'm very careful what stocks I do that on, because I've already had it happen to me with Celsius, which is a stock I owned and I was comfortable holding. So I bought 100 shares and for a couple of weeks I was selling calls and getting some income. And then the stock dropped like 5 or 6 or 7% in 1 week. So it didn't make sense to do weekly calls again. So I waited. I was like, it'll come back. And then it dropped, and then it dropped, and then it dropped, and then it dropped. And now I have 100 shares that are down 40%. And in the meantime, I have changed my conviction with the company has changed significantly because of other information I've learned. So I'm not going to say I got burned. I didn't make any dumb decisions. It's not an amount of money I wasn't prepared to possibly, lose. Because
you learned.
I did learn.
Yeah.
So, but it's, I don't know that I would have thought about that the same way if I was just putting my weekly or bi-weekly amount of purchasing into the market into that stock. It's just a different calculus the way I think about it. So that's how I would answer that question.
Yeah, Jeff, we have a lot of questions left. We probably have 4 or 5 questions left. So thank you to everybody that got the questions into us. Those that we did not answer, we will definitely answer them in our February mailbag. And, maybe we'll get a little crazy and do a little, maybe we'll do a little bonus content, maybe answer some questions at some point.
Slow down. I do one podcast a week.
Okay. But I mean, in 2 weeks, we'll be doing the live stream. So,
okay, never mind. Everything I say is nonsense.
Yeah, me too. We'll see what happens. Any final last words for the people here, Jeff?
I have nothing more to add. Just wrap us up.
Thanks, Charlie. All right, friends, as always, we love to give our answers, but they remain just that. They're our answers. Figure out your own. You can do it. I believe in every one of you. 2.5 years into this, people, you guys have gotten pretty good at answering your own questions. I know you're just giving us something to do. All right, Jeff, we'll see you next time.
See you next time.